Hey guys, welcome back to another episode of the 365 Days of Forex series, where we'll be teaching you everything you need to know and more completely for free here on YouTube. I do have just one huge ask from you, and no, it isn't a one-off payment of £3,000 to access my full course. It is, of course, that you smash that like button to help out with the YouTube algorithm. If you want to keep up to date with all of our future episodes, then you could also subscribe as well if you want them to be really, really nice. So in today's video, I'll be introducing you to currency pairs and which pairs are referred to as major, minor and exotics. So without further ado guys, let's get into today's video. Before we can begin identifying which currency pairs are major and which are exotic, we need to know what the term currency pair is actually referring to. Simply, a currency pair is a representation of the relative value of two currencies, with one being quoted against the other. The first listed currency in the pair is the base currency, and the second currency is called the quote. Without currencies being compared to one another, we would not be able to determine their values. So let's take a look at how you can interpret these currency pairs. There is a universal method of identifying which currency you're looking at by using the ISO currency code, which is a 3-letter code. The first 2 letters represent the country, whereas the third letter represents the name of their currency. For example, the first 2 letters in USD stand for United States, and the third letter stands for dollars. A currency pair is simply 2 ISO currency codes placed next to each other, for example, GPUSD. In a currency pair, the first currency is called the base currency, or GBP in this case. The second currency is referred to as the quote currency. Currency pairs compare the value of the base currency against the quote currency and provide you with an exchange rate which indicates how much of the quote currency is required to purchase 1 unit of the base currency. Let's use a real world example, which you may be a lot more familiar with. Imagine you've decided you want to go on holiday to America, which is pretty unlikely due to COVID, and you want to take £1,000 of spending money with you. Of course, when you're in America, your pounds will be pretty useless, and therefore you'll need to go to a currency exchange booth who will quote you an exchange rate. If you're unfortunate, you may be quoted a bad rate as the currency booth wants to maximise the profit that they'll make. Imagine that you've been quoted a rate of $1.2 per pound. This would mean that you receive $1,200 in return for your £1,000 that you've given to the currency exchange. Without even thinking about it or conducting any analysis, you've just taken part in your first transaction in the Forex market, albeit slightly different to those you'll be able to make after completing this series. After returning to the UK, you realise that you never spent any of your money, somehow, and you now have $1,200 which you can't use in the UK, as obviously dollars are useless in the UK. So you decide to go to the currency booth to get your currency converted back to pounds. When you go to the currency booth, you see that the price of the dollars have dropped to 1.2 to 1.1. That now means that for $1.1 you'll receive £1, meaning that when you exchange your $1,200 you'll receive £1,090. This means you made a profit of £90. We also need to be aware of the mechanics of what happens when you actually place a Forex trade. Imagine that you think the value of the euro against the dollar is going to increase, so you would enter a buy trade. This means that you think the euro will be stronger relative to the dollar in the near future. In this case, a simultaneous buy and sell transaction is occurring, where you're buying euros and then simultaneously selling dollars. This is a pretty strange concept to fathom. However, if you remember this fundamental concept, then you're already a step ahead of most retail traders. Now that you have a good understanding of how currency pairs work, it's time to understand what makes a currency a major, minor or exotic. Let's start with majors. Major currency pairs involve the US dollar. These include EURUSD, USD-JPY, GPUSD, USD-CHF, EUD-USD, NZD-USD and USD-CAD. These pairs have the most volume traded daily, and therefore often where the larger investors will do their business due to the higher volume and liquidity when compared to the minor and exotic pairs. Minor currency pairs are often referred to as crosses. These currency pairs are not associated with the US dollar. The reason that they are referred to as crosses is due to the fact that the dollar is actually partially involved in all transactions, however it is crossed out with the final currency pair. These pairs have a lower volume traded than the majors and therefore have slightly wider spreads due to the lower liquidity. An example of a cross could be something like GP-JPY or Euro-CHF. The final category of currency pair is the exotic pair. Unlike the name might suggest, these aren't fancy pairs that drive around in Lamborghinis.
Garage, just bought this new Lamborghini here.
They're instead from emerging markets. They aren't very liquid and the volume traded will often be notably less than what the minor and major currency pairs are. If your broker allows you to trade exotics, be careful of the wide spreads and large commissions that may end up catching you out and burning you without even realising. Here at FXE, we actually just leave exotics alone. It's also important to note that currencies can also be grouped by whether they have a strong dependence on commodity exports. For example, the Canadian dollar has a high correlation with the price of oil due to Canada's high exports of oil. AED and NZD also have a strong correlation to the price of precious metals and agricultural goods respectively. So guys, now you know how to identify your pairs from your pairs, you should be in a good position to begin telling your friends that you're looking to quit your job and become a full-time trading guru, as you probably have more knowledge than your favourite signal provider. In the next video, we're going to take a look at the different trading sessions that you can participate in and the different times that certain markets are open. If you enjoyed this video and you want to continue learning how to trade completely for free, then make sure you hit that like and subscribe button and turn on your notification bell as we upload these episodes multiple times a week. Why not also head in the comments section and let us know what currency pairs you like to trade. Cheers guys, and I will see you in the next one.